Thank you so much, Cyrus. There has been a lot of, talk with the mortgage rates coming down right now. People seem to be confused between fixed and variable. So, again, thank you. That's what we're going to talk to you about today. So just so our viewers know, Cyrus, just tell us a little bit about who you are.
Yeah, so I'm a mortgage broker, Cyrus with Premier Mortgage. I've been a mortgage broker for over 8 years now. So seen a little bit of the ups and downs here over the last good years and the bad years with the rates going and moving. So yeah, it's a little bit about myself.
Absolutely. Okay. Well, again, thank you for taking time. So how much did the prime rate drop? We hear on the news, oh, it dropped 0.5%. So let's put that in numbers for our clients. What was it? What is it now?
Yeah, so the prime rate of the bank was 6.45%. So now the new prime rate is going to be 5.95%. So that affects all your variable mortgages, all your home equity lines of credits. That's what that prime rate is based on. So it's down 1% as of the 23rd.
And that's what I want to talk to you about today and people to understand, because the majority of people have a fixed rate mortgage, right?
They do. It is fairly split between the two. You've seen a lot more fixed in the last 12 months, like a short-term fixed rates versus variable rates, but I'd say it's pretty even. Like, you do see a lot of variables still out there, so you do see some people obviously reap the benefits of the rate drop.
Okay, so with the rate drop, Cyrus, if you had a $400,000 mortgage prior to this rate drop, and now with the rate drop, how much would your payments decrease?
Yeah, so on average, it's about $110 for 400,000 is what that number works out to be. Again, depending on what bank and lender you're with as well. Some banks, they don't change the payment if your rates go up and down. They just allocate a difference towards interest and principal. But if you're with a bank that has an adjustable variable rate, payment should come down about $100 for every 400.
Okay, so there's a really interesting point you made. So there's two types of variable mortgages. You can get variable where the payment stays the same, or variable where you're paying more interest than principal, or more principal.
Yeah, so some banks do it differently. So for example, like RBC or TD Bank, their variable rate is essentially called a fixed payment variable. So what happens is if your rates go down or up, just more money goes towards principal or more money goes towards interest, which then results in either paying the mortgage off quicker or paying it off quite a bit longer. It's good when the rates go down because obviously you pay more towards your principal.
Right.
It's not so good when the rates go up because, yeah, your payment doesn't technically change, but then you end up in a situation where you might owe 30, 40, 50 years left on your mortgage because you weren't manually adjusting your payment. So it just depends on how you're set up. And there's other banks that do it in a way where your payment just automatically adjusts. So you're always staying on the right amortization track.
Yeah. Now, that's not too bad, always adjusting while they're going down. But my God, Cyrus, while they were going up, if you had a variable that was adjusting every time, I mean, that would hit you directly in your monthly pocketbook, your budget.
It would, but then you did get to a situation where I found a lot more people got into trouble with the variables that actually the payments did not change. Because what happened was that they weren't manually adjusting them. And you do end up hitting something called a trigger rate, which means that your payment becomes pretty much 100% interest. And then you're forced to change your payment anyway or apply a lump sum payment. Okay. So what would happen was that in the peak of all the increases, all of a sudden you saw some mortgages that were, 65 years, right? Because they were pretty much 100% interest on the payment or 95% interest on the payment. Clients weren't adjusting them, and then they were basically forced to adjust them basically when it hit that trigger rate. So the adjustable payment variables actually bear out quite a bit better because it keeps you, on track properly. And as long as you can weather the storm a little bit, it doesn't set you back, right?
All right. So you really have to set your budget that you have that, what I call your slush fund or your extra money or whatever, that that's there in case you need to pull that if it goes up, and if it goes down, I mean, that's great too. But then take that and put it in the slush fund, right? Which most people don't do in today's world, and most people can't.
Right.
Does it affect fixed rates?
No. So that's a very common question we get. So what we do is whenever we see the rates change, we actually send a note to clients that are coming up for closings. Because the common question is, oh, the rates dropped 0.5%. Does that mean my fixed rate is down 0.5%? And the answer is no, because variable mortgages or Bank of Canada affects the prime rate, which has a direct impact on variable mortgages. Fixed rate mortgages move off a different metric. They move off the Canada bonds. So because if the variable just went down 0.5%, you actually didn't really see any change to the bond yields, which did not actually have any impact on fixed rates. Typically what you see happen in a fixed market is really the bond yields have kind of priced in these drops ahead of time. So that's why fixed rates a year ago were 6%. Now they're in the mid 4s, right? So they've anticipated a lot of this drop by Bank Canada. They've adjusted it, but you don't see a direct correlation between Bank of Canada making an adjustment, fixed rates changing.
Okay, so when you say bond yields, you're talking about Canadian bonds like that people invest in,
Correct.
right?
Yeah, and those are driven by a multitude of different factors. One of the big ones being obviously U.S. Treasury. So you do see us kind of get dragged along a little bit based
Yeah.
on what happens there too. So it's never a direct correlation between Bank of Canada making an adjustment and fixed rates dropping.
All right. So what would you consider a good instance to go variable or a good instance to go fixed? Like what would be kind of your on when you're giving people advice?
Yeah, it really depends on everybody's, personal situation is a big one. If you're 65 on a pension fixed income, you probably don't want to take the risk of going variable and having that payments adjust if you just can't afford fluctuation. If you're in an income or you have a lot of disposable income or you're well below your debt to income ratio, variable is a great option because it keeps you flexible, lets you play the market a little bit, ups and downs. Obviously, the last 2 years have not been the greatest for variable, but historically, variable does work out to be better. It also keeps you a little bit more flexible when it comes to a penalty. If you need to break your mortgage, it's only 3 months of interest penalty. So variable has a lot of positives. It also has obviously some drawbacks and negatives. The big one being, can you weather that storm if the rates go up? Because that is always a reality. They're not, right now people say, well, variable is the way to go. Rates are coming down. Sure, but they could also go back up. So you do have to be willing to ride that cycle and that wave, right?
I think, Cyrus, you have to have a really strong person that can handle it. In other words, I'm risk adverse, right? Like
Right.
I can't do a
Right.
variable mortgage because I'm the type of person
Yeah.
that, oh, what? Oh, what? But so you have to be the person for variable has to be very diligent, has to they watch their finances, they look at those payments, they know where the money's going to come. If it goes up, they know they're going to save the money if it goes down. So I think, very, very budget-minded people, more so for variable. I'm of the fixed.
And there's a price to pay for peace of mind. Like if you'd rather just go fixed, not worry about the rates going up or down. Variable is one of those things where you really have to just set it and forget it, and you have to ride the wave. It's almost like investments. You don't want to start panic selling when everything's going to the wayside. You also don't want to be, locking in the minute rates start going down. You really do have to kind of sit in it and let it do its thing. And you have to be able to, weather that storm, right?
So people that are on what you and I call a fixed salary, you know what you're going to make, that's easier. I mean, you and I are both commission based, so it's really hard to we never know from month to month. We can predict and we can work towards it, but it's not like someone who knows every single month I work for this company, this is my pay, this goes into pension, this goes into this goes into medical, you know what I mean? Would be a better fit for a variable.
Yeah, it's something where it's just, again, it's all risk portfolio. It's typically you can tell by how people invest their money, kind of what direction they go with their mortgages as well. And just people who are really in tune with the market too. First time home buyers, it's a tough one because obviously they're buying a home for the first time. They might want to get their feet wet with exactly what to expect for expenses, insurance, just overall owning a home and costs. So sometimes they're not willing to take the risk on a variable like someone who's owned multiple homes in the past. So you do see a lot of that play into the factor of it as well, right?
Okay. And if somebody has a fixed rate, because a lot of people don't realize this, the banks, the more money you put down, which shows that you're stronger financially, the higher your rate is with the bank, your fixed rate.
Yeah, so it's more just between insured and conventional mortgages. So if you put less than 20% down, your rate's always going to be lower than if you were to put 20% down or more. The reason for that is because under 20%, the banks have insurance. So essentially what that is that they don't have to risk manage it as much on the back end of their portfolio as they would if you put 20% down and they don't have the insurance, because they're the ones that have to basically protect their bottom line, right? Exactly. So when you put 5, 10, 15% down, the banks can kind of get skinnier on their margins. They can then pass those savings along. It never makes sense to put less than 20% down to get a better rate. Get that question a lot where clients say, well, what if I put 19.99% down? I've really never seen a situation where you save more in interest than you would in the insurance premium. Okay. So if you can put 20%, it's always better, but you do get a little bit of a break by putting less than 20, just with the rates being a little bit lower. Yeah. So
I hear a lot of people right now, and I'm not sure if you're hearing the same thing, but from on the real estate side, I'm hearing a lot of people and they're saying, well, especially the last 6-9 months, you know what, I'm going to wait. And I'm going to wait for the rates to come down even more. And as you know, I mean, I'm the real estate stats girl here in the city. Every Monday, I want to know what's going on. So the median sale price last week was $535,000. The average sale price was 642,000. We are seeing both those numbers consistently climb. So what would be your opinion if you're waiting for a rate to go down 0.5%? You're going to save, like, as you said, $110 a month, but the house is now, what was 535,000 is now 555,000.
You have to think about buying a home as an overall cost, not necessarily just a monthly payment like you just mentioned, right? So I could save a little bit of money per month, or maybe my interest cost is slightly less, but then I'm paying X amount of money more for the home. Because what happens is if the rates go down, more buyers enter the market, it becomes more affordable to certain people. Then all of a sudden you end up in a larger buyer pool, which obviously we know how that ends up with multiple offers or, just supply and demand, right?
Exactly. What's your split, Cyrus, between fixed and variable? And is there a certain demographic that tends to go more variable?
Yeah, so I would say, in the last 12 months, I would say 99% of clients were either on a 3-year fixed or a 5-year variable. And that split really being probably 80% 3-year fixed, 90% 5-year variable. And then now you're starting to see in the last month or two, you're starting to see that more maybe like 50-50 or 60% fixed, 40% variable. So you're starting to see that variable make a comeback quite a bit and expect it to as it kind of keeps.
I remember when I first got into real estate, almost everybody did a 5-year fixed. And you just mentioned a 3-year fixed. So 2 questions. Why the 3-year fixed, and what's the difference in the fixed interest rate?
Yeah, so the big reason why people were going to 3-year fixed is they're really just trying to weather the storm on the fact that we know rates are going to be coming down, but we don't want to be locked in for longer than we need to, right? So the big issue there is that 5-year fixed is great, but if you can get a 3-year fixed at equivalent or very close to a 5-year fixed, and then be able to renew your mortgage a few years sooner when rates are down, that's been the thought process behind the 3-year fixed, right? So it's just allowing you to take a shorter term, because you might ask, well, why don't people do a 1 or 2-year fixed? Because those rates are extremely high. Like the 1s and 2s, pretty much in like the 6s and 7s for a long time on the rates, where the 3-year fixed was maybe just a tad higher than the 5-year fixed, maybe by 10 or 15 basis points. So you were getting a situation where you were getting a 3-year priced very close to a 5-year, 2 shorter years, giving you a chance to then renew with hope that the market levels out and you get into a lower interest rate rather than being stuck into your 5-year for essentially 5 years. Right?
For 5 years. You mentioned at the top of our video, the rate right now, you said mid-4. So if I was to, send a buyer through to you now, what typically would be the fixed rate for 5-year right now?
5-year, and this is where there's such a large kind of gap between banks and lenders right now, but you're seeing anywhere from 5-year fixed around 4.3 to 4.5% on average. Mm-hmm. You're seeing 3-year rates in some cases around the 4.5% mark as well. In some cases, even a little bit lower. So that's generally where the rates are floating, kind of in that mid 4% range, give or take 0.25% one way or the other. But it's really, everything's pretty much starting with 4% now, which is really good.
And you brought up a good point there. You said between lenders and banks. So when I spoke to someone at one of the big 5 banks yesterday, they had said their fixed 5-year was about 4.6. And I said, oh, I was just given like 4.39. And they were like, no, it can't be. It can't be. How can your lenders, I know you can work with banks too, because you look after my clients, and thank you very much, do a great job. How can those lenders, who are they, and how can they go lower than the big 5 banks?
Well, to be honest with you, the banks, it's kind of time of year too, depending on what the banks want to do for their own, I guess their own quarterly outlooks or their own projections. But you get into a situation where like Scotiabank was ultra aggressive this year. Some banks kind of backed off a little bit in certain terms. So it's not necessarily the non-bank lenders versus the banks. It's just really bank to bank or lender to lender. Sometimes it's just depending on the time of year or what rate specials might be out or what products they might be kind of focusing on, that you end up getting a better. And that's why, it's not all banks are created equal. Not all offers are the same. So for us, we can kind of look at everything and say, okay, well, here's, for example, TD Bank is priced here, but BMO's over here, right? And this is why, and then we can kind of compare the two. But this is kind of the challenge of the bank, is that if you deal with the bank specifically, they're going to say, well, there's no way there's lower rates elsewhere. Well, there is, and it could just be the next bank over, right? But, and then you want to look at the product and make sure it all makes sense. But yeah, I mean, it's honestly just bank to bank, where they are, kind of what they want to do for their own bottom line, right?
I find the banks stick a little bit kind of within range, but the lenders tend to be bit. So we keep using the word lenders, and I know our viewers out there don't know what we mean by lenders. They're trust companies, right?
Yeah, so mortgage, they're essentially mortgage finance companies is what they are. So they're just non-bank lenders, and they're essentially just dealing in the mortgage space. So they tend to get a little bit different margins here and there. But again, like you looked at this year, the non-bank lenders weren't that great on the 3-year fixed. Whereas, for example, Scotiabank was blowing everybody out of the water, right? So TD Bank was super aggressive in the beginning of the year, and then they kind of tapered off throughout the end of the year, right? So you do see a lot of aggressive offers from lenders, mortgage-only lenders as well, for sure.
Well, the mortgage-only lenders, like they're private corporations, their goal is profit. I mean, I know the banks are too, but they don't have the same regulations as the bank either, do they?
They do, yeah. For the most, everything's now
They
basically
do all
regulated
the
from
same.
top down. Yeah,
Okay.
because a lot of the non-bank lenders are all on the back end securitized by like CMHC or mortgage insurance or whatnot. So they do share a lot of the same rules and regulations. It's just a non-bank lender doesn't have that physical brick and mortar.
They just do
Yeah,
more. They just focus on it.
exactly.
So just to finish off here, Cyrus, what would be your best advice for somebody that is renewing a mortgage right now?
Yeah, again, the advice will kind of hold into where they stand kind of financially on their own personal situation, but you do want to plan for the future a little bit. So you do want to be mindful of not just signing the renewal your bank sends you, get a second opinion on it, see what's out there, talk to a professional and say, okay, what is the outlook? What's the best information we have today? And what's the most educated decision we can make based on that information? And then go from there. Obviously, 5-year fixed has always been the most popular or been the most popular term in Canada for many, many years, but that hasn't been the case the last couple of years. So you do want to have that conversation and educate based on, okay, well, what's coming down the pipeline, and then how can I set up my renewal so that I can take advantage of that down the road as well, right?
Okay, like I said, I'm fixed because I am risk adverse. But so many of the people that we know, they were all just losing it because their payment, like the rate kept going up and going up. So whether it's their payment or not affected, it's still affecting financial, their equity, and what are they paying, interest or principal. So we kind of watch now that they're going down. Do you think we're going to see them continue to trend down, Cyrus, over the next couple times at the bank? So they'll put another one out in December. Is that when the next one comes?
Yeah, next one in December, and then obviously 8 more decisions through the next, obviously 2025. So it's tough. I mean, I think most banks are thinking you'll see rates anywhere from 1% to 2% come down the next 12 months. So there are some pretty aggressive projections on what's going to happen with prime. So I think we'll see at least 1% in the next 12 months. I think we'll see it come pretty aggressive to kind of bring that prime down under 5%. And then fixed rates, I think we're going to probably hover somewhere in the high 3s next year.
I remember back in 2008 when they hit 4.99, I emailed flyers everywhere I could. Like, I was in shock because, of course, I'm a boomer. I started buying my homes at 14, 15%. So I've watched it just continually come down my entire life up until this recent rate hike. Interest rates they've been coming down, Cyrus. That's scary. That all of a sudden, because you have an entire generation of boomers that, and when I say boomers, I'm talking about the younger boomers, that we never experienced them ever going up. We all remember paying 18% on a home, 21% on a car, and just continually come down.
Yeah, for sure. And you do see, it's interesting because you see two sets. So you see, like what you just mentioned, you've only seen the rates come down. And then now you get the generation who's bought a home in the last 4 or 5 years, and they're just really seeing the rates now. They bought at the lowest point, and now really all they know is rates going up. So
that's right. It
is one of those things that there is a happy medium somewhere in there. I think that's probably somewhere in the mid to high 3% range. I think we can sustain that. That's a good kind of an overall number, but I don't think we see 1s and 2s anymore.
I don't think we should. Like, government created this perfect storm where they dropped them so low, then the demand went up. We all saw what happened to the market here. People being literally priced right out of the market, but right. You and I talked last January, and I did my prediction for the end of the year, and we'll see if my prediction's right. So I had predicted fixed rates to be at 4 by December 31st. Yep. I'm starting to think that might not happen. What do you think?
I think we could get close. It's hard to say. I mean, you did see some softening over the last couple of months. I mean, we're low to mid 4s now. So I don't think it's unreasonable to think that maybe by the end of December we might see what happens with fixed rates, but I don't think you're far off, right? So we'll
Okay, so
see.
I may not have to eat cake on my video in January. Yeah.
I think we should be pretty close.
Okay. And one last thing that I do, we talked a little bit, I want to kind of finish off with this. That if you're going for a mortgage or if you're refinancing, just because you have been with somebody for so long, there's a lot of things have changed, especially for us boomers in this, or, you're still in touch with your realtor, or reach out to a realtor and say, who do you have that can help me, that explain which way I should go or what should I do with refinancing. When new buyers are buying, we always give them the advice. But when people are refinancing, it's like old habits, right? So I just want everybody to know, like, even if you know a real estate agent, reach out to them, say, I'm refinancing. Who can you give me? I mean, I get calls like that and I send them to you. And then they can make a well-informed decision. Do I want to stay with the big bank? Do I want to go with a mortgage lender? Do I want fixed? Do I want variable? Just get all the information necessary to make that decision.
Yeah, of course. And there's so much information out there that it becomes Google's a bit of a rabbit hole. So if you can get someone you trust and you can get their opinion on it, it's your best bet for sure.
Yeah, and absolutely talk to them. So financing to new buys, Cyrus, what's your percentage there?
Geez, I think us and our team, we do a lot of purchases. So we're probably 70% purchases, 30% refis or renewals. But it's you're starting to see refinance pick up a little bit more because you're starting to see the rates come down. No one was refinancing where rates are in the sixes. Obviously, they were renewing, but they weren't pulling cash out of their homes to consolidate or to buy other things or whatnot. So you're starting to see that pick up a little bit more now that the rates have softened out. So that percentage should probably go more like 60-40 on the purchase side. But it's still I mean, purchase numbers this year have been obviously really good too.
So you do a lot of work with refinancing, because that's what I always tell people. So like I say to all our viewers out there, if you know a realtor, you got a friend, family member, somebody's a realtor in your world, ask them who they deal with for mortgages and let them talk to that person and say, which way should I go? Possibly you may have a better product than what they've had for the last 5 years.
Yeah, or just a 5-minute conversation. You might end up staying with your bank, but at least we had that conversation. It gives you a little bit more information that you came in with, right? So
all right. Well, we're running your name and number across the bottom of the screen here so all our viewers can see it. We tend to make the process look simple to people, but you and I know it's not a simple process because we're in the background making sure it's a simple process for them. So please reach out, anybody out there that has any questions. And Cyrus, I thank you so much for taking the time to come and see myself. Miss Frankie's right here. You probably should have been snoring a bit, so I hope no one out there could hear it.
my pleasure. Thanks so much, Brenda.
All right. We'll talk to you later. Bye.
Take care.